It's been a volatile week for the FX market, but will things quiet down in the Forex market this upcoming week? I'm Christina Marujos. Thanks for joining us at XM.com for the week ahead. Helping me unpack this week is our lead market analyst, Rafi. Rafi, Donald Trump's victory and, of course, return to the White House acted as jet fuel for the US dollar and US stocks. And despite the dollar surrendering some of its gains, it stabilized after the Fed delivered another 25 basis points rate cut. Do you think this upcoming week's data, US CPI and retail sales, could offer the greenback some support?
Well, Christina, it's indeed been a very exciting week for the markets, that crucial US election and, of course, the Fed decision. In the upcoming week, though, I think we're going to see a bit of a return to a normality in terms of financial markets having already digested the aftermath of President Trump returning to the White House and the Fed kind of maintaining its caution over the interest rate outlook, over the inflation outlook. But of course, we do have the CPI report coming up for October, which is, as always, it's going to be very important because we have seen inflation not come down quite as fast as expected in recent months, and we did kind of hear Powell acknowledging this in his press briefing. So although it's obviously maintaining its downward path, we are seeing some stickiness in underlying measures of inflation. So it's going to be important to see some further progress for the month of October because the December meeting, it's no longer a done deal in terms of another rate cut. We did hear Powell sort of very gently opening the door to the possibility of a pause either in December or in one of the upcoming meetings in early 2025. So should we see some upside surprises in either the CPI or the retail sales data, I think we might see rate cut expectations for December come down even further, and that would potentially boost the dollar even more than it already has over the past week or so.
Now, the Bank of England yesterday also delivered a hawkish cut, pushing the pound slightly higher. How could we see sterling perform on the GDP and jobs data?
So it's kind of interesting now with the Bank of England because I think the Bank of England was headed towards lowering its inflation forecast because there had been some very good progress, not just headline numbers, but also in core inflation data as well for the UK. But what we saw from the budget, spending is going to go up a lot more than what anyone had predicted. So overall, it's going to be an inflationary budget, even though we are also getting big tax increases. So I think what the budget did is actually put us back where we were prior to the recent improvement in inflation data. So Bank of England, they said that the budget's not going to affect their the current rate path, but the fact is that had it not been for the budget, I think the bank was ready to lower its rate path because of the recent progress in inflation. So overall, depending on which way you look at it, I think the budget has affected the interest rate outlook for the Bank of England. The bank has no choice now to maintain its cautious. They can't pre-commit to further rate cuts. They're probably going to proceed with quarterly 25 basis point rate cuts. Now, in terms of next week's data, we're probably going to see symmetrical impacts, so stronger than expected data either in the job numbers, particularly the wage growth, which is the main focus in the jobs report, and then the GDP numbers for the third quarter. I think that would definitely reduce expectations for aggressive easing and boost the pound, and then vice versa should we get any disappointing data.
And finally, Rafi, let's cross into Japan. The yen took a hit from the stronger dollar this week. Can the Japanese GDP data offer it any support?
Yes, we may well get some support for the yen from the Japanese GDP readings because the Bank of Japan now, of course, they were ready to hike rates further this year, but then they suddenly turned cautious because inflation started to ease off a little bit. We also did see some disappointing economic growth data. So there is no urgency for the Bank of Japan to raise interest rates further. So there's slight chance we might get a rate hike in December, but most probably the BOJ will probably wait for until after the next year's spring wage negotiations to get a clear idea of, how much Japanese businesses are basically how big a pay rises they're offering to their workers. Of course, this was the main factor that drove the BOJ to basically end its stimulus programs last year. So another good spring wage season would definitely lead the bank to raise rates further next year. But for the BOJ to act before that, I think we would have to get some pretty strong economic data. Now, the GDP data alone that's coming up next week, that's not really going to change much, but it might basically if we get a series of upbeat numbers out of Japan, I think that would potentially boost expectations for a December or January rate hike. So that's why we might get a small boost to the yen should we see any upside surprises.
Rafi, thanks so much for joining me today. This was The Week Ahead at XM.com.